Good morning. My name is Ali Kazmi. I'm Managing Director at Hansuke, and it's my pleasure to welcome all of you to our webinar to discuss the changes in the UK DAC6 rules and also discuss the practical implications. Our webinar is set out in two parts. So the first part is a fireside chat with John Buckridge of Hansuke, with James Marshall and Paul Hondius of HMRC and OECD respectively. And then for the second session, we will take a 15-minute break, and then we will come back with the panel discussion. I would invite you to please, on the right-hand side, you will see a button saying chat. Please introduce yourself. Let us know where you're coming from. And also, please feel free to pose questions as the proceedings go along. With that, I will hand over to John Buckridge, who's a principal at Hansuke. Thank you.
Okay, my name's John Buckridge, and I'm working with Ali at the moment on Hansuke. But my previous experience is with HMRC and with funds tax. The area we're looking at the moment is a statutory instrument that was introduced very suddenly by the UK government on 30th of December. It wasn't particularly expected. What it actually did was withdrew most of the UK's involvement with what's known as DAC6, Directive on Administrative Cooperation, Amendment 6, which is all about reporting arrangements that fulfill certain hallmarks to HMRC. This is essentially an international anti-avoidance provision, the whole of DAC6. And the object is to ensure that arrangements that have certain characteristics or hallmarks, as they're called, have to be reported to HMRC so that it makes it harder to hide arrangements which are likely perhaps to avoid or evade tax on an international basis. What HMRC did on the 30th of December, there were Treasury regulations published which withdrew most of the DAC6 reporting. There are 6 hallmarks, A to E, and it withdrew the requirements to report on all of them except hallmark D. Just to give a little bit of history here, the DAC6 reporting requirement is itself based on some work that was done in OECD and was commissioned by the G20 from OECD. And that work was very much about international tax transparency, international tax reporting, and part of what's called the base erosion profit shifting scheme, trying to prevent the erosion of tax bases. And one of the many actions resulting from that work, action 12, was called mandatory disclosure rules. And quite a lot of work was done on that. And the DAC6 was the European Union's response to that. And it requires reporting of arrangements that fit various categories. The only area the UK had itself legislated to require DAC reporting under the same rules as DAC6. Of course, the UK has now left the European Union, but there was no obvious reason in advance to expect it to change those rules. As I say, they were agreed by the European Union in order to fulfill the OECD project, which the UK is very much still part of. But the UK on December 30th produced legislation which withdrew all of the hallmarks bar one. I think we want to hear a little bit about why that is, and we've got speaking with us today James Marshall from HMRC and also Paul Hondius from the Organisation for Economic Cooperation and Development, OECD. Having just said that much, I'll ask them just to introduce themselves a bit and then ask 1 or 2 questions about this. So, James?
Good morning, everyone. So my name's James Marshall. I obviously work in international tax in HMRC, and I am the policy lead for DAC6 and mandatory disclosure rules.
Yes, good morning, everybody. My name is Paul Hundius, and I am the head of harmful tax practices with the OECD Center for Tax Policy and Administration. And as one of my previous projects that I worked on, I did a lot in the exchange of information space, and one of those was, of course, the OECD mandatory disclosure rules for CRS avoidance arrangements and opaque offshore structures.
So obviously, as you can all hear, James and Paul are very well positioned to be able to talk about the area we have under discussion today from both the HMRC and OECD point of views. So if I can just start with James, first thing to say is the statutory instrument published on 30th December rolled back some of the requirements that had been published earlier in 2020. Why did it do that?
Yeah, thanks, John. So, so I think it's probably helpful to give a bit of background there to the instrument that that came into effect on the 31st of December. So DAC6 is obviously an EU directive. And as you noted, it requires member states to collect information on arrangements that concern one or more EU member states and which meet certain hallmarks. The UK legislated to implement that, or to transpose, I should say, that directive while it was still a member state in January 2020. And during the transition period, that directive continued to apply to the UK, and accordingly, the UK sort of continued the work on implementation there during the transition period. Following the end of the transition period, the directive ceased to apply to the UK as the UK was obviously no longer a member state, and outside the transition period was no longer treated as such. So following the end of the transition period, the UK government position is to move to the sort of globally agreed rules on tax transparency, and those are the rules that the rules and standards that have been agreed at the OECD level. So in relation to these types of sort of the disclosure regimes on these types of arrangements, that is the Paul mentioned earlier, the model rules on mandatory disclosure of CRS avoidance arrangements and opaque offshore structures. And so the UK government has announced that it will be implementing those mandatory disclosure rules. Those were developed around the same time as DAC6 back in 2018, and as I say, require reporting of those structures that could be used to sort of evade tax. So the government has confirmed it will be implementing those rules as soon as sort of reasonably practical. And we're sort of expecting, while the timelines are obviously still to be confirmed, we're expecting to be consulting on regulations to implement that during the course of the next year. In the meantime, there is still some reporting required under DAC6, and that stems from the obligation in the Trade and Cooperation Agreement agreed between the UK and the EU, which requires maintenance of standards at levels equivalent to those agreed at the OECD. But I think fundamentally, the DAC no longer applies to the UK now that it is no longer an EU member state, and so it's sort of appropriate for the UK to be transitioning to those global rules on tax transparency.
Just to follow through briefly before I ask Paul to comment. Obviously, the rules that have been retained, which is the hallmark D, I think, from the as it's called in DAC6 and is still called in the UK legislation, is concerned with or information about any schemes that might avoid the automatic exchange of financial information under the common reporting standard that's been agreed internationally, and also that might hide the ownership of arrangements of finance or companies or whatever. That's the information, that's the obligation that's been retained, and it's obviously easy to see, relatively speaking, why those rules exist from and have been the OECD's put in a set of recommended rules, and I think DAC6 is probably compliant. The category D of DAC6 is probably compliant with those recommended rules, but Paul will no doubt be able to comment on that in a moment. But clearly the other categories were also intended to require people to report information that were signals of other forms of tax avoidance. I mean, for instance, the confidentiality clause in Hallmark A is a very common feature of tax avoidance schemes. So, is the UK effectively weakening its anti-tax avoidance legislation by doing that, but by no longer having arrangements that similar to DAC6? James.
Yeah, thanks, John. So I would very much say no there. The UK has a strong disclosure regime. So as I'm sure you're aware, the UK has its long-standing DOTAS regime, which requires disclosure of arrangements and schemes that generate a tax advantage, which is one of the main benefits of the arrangement. And that has a number of hallmarks, which obviously HMRC, monitors closely. Those include many of the same cover much of the same ground as some of the hallmarks in DAC6. So particularly, you gave an example there of some of the category A hallmarks, and similarly the category B ones that are subject to the main benefit test too. And indeed, if you mentioned earlier the BEPS report covering mandatory disclosure regimes, and indeed that report refers back to examples of disclosure regimes in different jurisdictions, and what sort of worked well in some, and what sort of lessons can be learned for jurisdictions, and that report refers indeed back to the UK's DOTAS regime. And I think, it generally recognises, I think it's generally recognised that the UK DOTAS regime is a strong disclosure regime. So I think, there's a question there about the relative sort of merits of duplicate, or the risks around duplication of reporting if something is already reportable under DOTAS, then is having it reported a second time a proportionate action. And what we've done here is focused on the areas where we consider there to be the tax risks where HMRC would most benefit from having information reported to us. So given the regimes that we already have in place, given the and then implementing the mandatory disclosure rules to cover those additional hallmarks, focus more on the evasion space, as you mentioned, the opaque offshore structures and CRS avoidance regimes. I think we very much see that as maintaining our commitment to tax transparency.
Right. Okay. Thank you, James. If I go to Paul for a moment, I mean, it's James has said that he does not see this as weakening the UK's commitment, if you like, to following the OECD recommendations, and indeed to encourage to implementing Action 12 generally. Now, Action 12 clearly is wider than merely the automatic exchange of financial information. So, it clearly does look at other forms of information. So, Paul, what's your sort of take on this? Do you think that what the UK has done does appear to weaken its commitment at all?
I think certainly not from an OECD perspective. I think there are two work streams in terms of mandatory disclosure rules that we have been working on in recent years, and I think they were already both referred to. The first one being Action 12, which tried to formulate possible approaches and best practices in relation to domestic mandatory disclosure regimes with respect to corporate tax planning. And as James has already rightly said, one of the examples of such a domestic regime that is referred to in the Action 12 report are the UK DOTAs. And so I think in that sense, probably two observations. On the one hand, the DOTAs are explicitly cited as one of the examples of how an Action 12 mandatory disclosure regime could look like. I think secondly, it's also important to bear in mind that Action 12 within the broader BEPS project is not a minimum standard. So it has the function of a best practice. In that sense, it is not something that is peer reviewed or where there is an international commitment by all members of the BEPS inclusive framework to implement Action 12. So I think in that sense, the work that the OECD has done in that regard is really to formulate approaches that countries interested in mandatory disclosure rules could take. And as I've said, the UK DOTAs are an example of such a mandatory disclosure regime under Action 12. And then, of course, there is the second piece of work that we have done in the mandatory disclosure space, and that relates to the CRS avoidance arrangements and opaque offshore structures. And there we have developed a set of rules that correspond to Hallmark D of the DAC6 directive. And that is then complemented with an international exchange framework that we have developed under the multilateral convention, a multilateral competent authority agreement that would then allow the exchange of information of the information collected under the OECD mandatory disclosure rules for CRS avoidance arrangement and opaque offshore structures. And that is in the CRS and tax transparency space, the work we have done, which I think in terms of purpose is different from the mandatory disclosure rules under Action 12, in that under the CRS related mandatory disclosure rules, we're looking for structures of facilitated by intermediaries that seek to short circuit, if you want, the reporting under the common reporting standard or the transparency with respect to beneficial owners. Whereas, of course, the focus of the Action 12 mandatory disclosure rules is much more on corporate tax planning structures and getting transparency on what corporate taxpayers do in terms of structuring their international tax affairs.
Okay, thank you. So I think if I got you right, you are emphasizing that, in fact, the recommendations, the ideas behind Action 12, I mean, the mandatory disclosure rules relating to CRS, the common reporting system, and indeed to opaque offshore structures, those are one aspect of Action 12, and those are the one where you were talking about you have some rules, and effectively category D or hallmark D is the EU's implementation of them, and the UK has implemented it in exactly the same way as what was the rest of the EU, what is now the EU. But the other categories in DAC6, the UK's DOTAS measures are the EU's implementation of lots of the other aspects of Action 12, and the UK's DOTAS measures are in effect the UK's implementation. Have I got that right, James and Paul? Really, either of you coming in?
Well, I mean, I guess the point I would make is that the DOTAS regime predates the Action 12 report. So, you know, and as Paul mentioned, that report refers to the DOTAS regime as being a a good example. I think it's fair to say a good example of the sort of approach that could be taken to developing a mandatory disclosure regime. So I don't think it's necessarily that DOTAS is the UK's response to Action 12. More almost the Action 12 picks up on the Action 12 report picks up on some of those concepts.
I see your point there. So does that mean we can probably expect some further work certainly in the UK in the future in order to pick up on any perhaps to improve DOTAS and that kind of way, to pick up on any further aspects of Action 12 to get the best possible practice?
Well, I think HMRC certainly, keeps the DOTAS regime under review, and I know there have been plenty of, amendments to it over the years. I'm not sure that I could sort of commit to anything in terms of the scope beyond that, because that's outside my area of policy and expertise.
There's a question
we keep under review.
There's a question one of our attendees has put up here from Laura. It's from addressed to you, James. It says, comments that DOTAS only covers domestic transactions and as it stands would not prevent cross-border shifting of profits based on transfer pricing tax planning, but that's just one example of international tax planning. If the UK just implements the OECD MDR on CRS anti-avoidance, it wouldn't prevent that kind of profit shifting. Have you got any thoughts on that? Would it not make more sense to either expand DOTAS or implement the MDR rules more in line with BEPS, more internationally, in other words, to pick up international profit shifting a bit more?
Well, and I guess that kind of comes back to the point that Paul was making earlier, which I think it does anyway. So unless Paul disagrees, but I think the model mandatory disclosure rules for CRS avoidance and opaque offshore structures and DAC6 both have at their sort of heart, they are exchange of information mechanisms between tax authorities, and that is sort of fundamental to the operation of both sets of rules, whereas the BEPS Action 12 report is not so focused on exchange of information. I think I'm right in saying that it doesn't have a built-in exchange mechanism in the way that MDR and DAC6 do. So I think in terms of UK implementation rules, I mean, again, there's a point about DOTAS. It's not really for me to comment on what the UK could do with DOTAS beyond noting that we do keep it under review. In terms of implementing MDR, as I say, that is an exchange mechanism. So collecting information to exchange it, but where no one else is implementing those same rules and is going to be able to exchange it, I think they're two different sort of pathways. They're two different strands of work, as Paul mentioned earlier. So I think keeping DOTAS under review is absolutely something HMRC does, and then implementing the MDR rules is something that the government has committed to doing. Trying to expand the scope of the MDR rules on a unilateral basis, I don't think necessarily works when we've got when it's sort of predicated on that exchange of information function. I don't know if that Paul's view on that is similar.
Yeah, no, I think that is a fair summary indeed, and you're absolutely right in saying that Action 12 does not have as a key component exchange of information. The focus is much more what could national governments do in terms of getting increased transparency on the structuring of cross-border tax arrangements that are done either by taxpayers and or intermediaries in their country. There is certainly an aspect within the JITSIC framework to share intelligence on structures that you come across. So there is this, let's say, less structured and more informal mechanism of cooperating under Action 12 that is contemplated, but there is certainly not an automatic exchange component to it, as we know it both from the CRS-related MDR rules that we have developed as well as from DAC6. So I think that's absolutely right. And in a certain way, I think it's also not unfair to say that the other hallmarks under DAC6 are indeed a a measure taken at EU level to implement some of the issues raised in the Action 12 report, but the mechanism chosen, of course, is a measure that has been decided at EU level, and is certainly one possible way of trying to address the best practice recommendations that we have made in Action 12. But deliberately so, Action 12 does not mandate a certain way of addressing the issue, and so I think in that sense, DAC6 is a reflection of the EU reflections on how to best address these points, without necessarily being the right or the wrong way, but just a possible way to address the issues posed by cross-border tax structuring.
Okay, thank you. I don't know if anybody else, I haven't picked up any more questions at the moment in this. So in the absence of those, I'll just say, looking at the general principles of tax transparency and of trying to improve tax transparency, not obviously, I mean, what HMRC is coming from, I think James has emphasized several times, is taking a rather more, that DAC6 is a very intra-European arrangement to get tax transparency within Europe, but and the UK is trying to take a much more global approach, I think, probably to the tax transparency. But the question is whether on a European or a global level, what other measures do you foresee or are possible that will improve general tax transparency across jurisdictions in order to improve compliance, obviously?
Well, I'm happy to go first, and then I'm sure Paul will have additional points to add. So I mean, certainly on an international basis, there is a lot of work going on at the OECD and elsewhere on tax transparency. So the OECD published its model rules for reporting around digital platforms last year, and there is work ongoing, around existing mechanisms such as the CRS. I guess there is always a longer term question about, what is the future of tax transparency, and that's not necessarily one I'll try and answer in any detail today. But I think there are, as we work on these issues with international partners and at the OECD, it's clear there are always new areas coming up and new areas to consider, and I guess there inevitably has to be work around what are the priorities, where are the biggest tax risks that authorities need to address, and where that collaboration will be sort of most valuable, and where those efforts should be focused.
Yes, I think maybe to complement James's answer. I mean, I think of course the MDR space, and I know this is a dangerous term for a European to use with a UK audience, but is in a certain way a backstop, really. In the sense that I think it tries to address remaining issues that may arise despite of all the other measures that we have taken. I think, for instance, in the CRS space, what we're trying to address through the MDR rules is precisely those cases where there is an unwanted outcome. So where intermediaries are involved in trying to deliberately avoid reporting of financial accounts that would otherwise be reportable under the CRS. And I think that's of course the space where we have made the major progress in terms of enhancing transparency. That is precisely true. The CRS policy and all the exchange of information that has resulted from that. And I think similarly in the BEPS space, or in the corporate tax space more broadly, there are of course transparency items in the BEPS package that are minimum standards. I'm thinking in particular about the exchanges on tax rulings. Also, obviously thinking about country by country reporting, the enhanced cooperation under the dispute resolution mechanisms of Action 14, just to name a few. Of course, also the work on regimes that we are doing and addressing unfair tax competition. But I think it's at the same time fair to say that this is never something where it's a very dynamic space, international tax, and then things evolve, and so it's never done in the sense of we can now all relax and retire. There are always new frontiers to explore. One of the big ones, of course, that we're currently working on is in relation to the challenges of the digital economy on international tax systems and how we can best address those. And transparency, of course, is an important dimension in that project, in addition to the debates on how to best ensure taxation of the digital economy. And then I think in parallel, now moving a bit more to the financial intermediary space and financial markets, there are, of course, developments, and I'm thinking in particular about the crypto markets that are no longer just illuster, but that get a more widespread and retail element to it, and that, of course, also then begs the question at OECD level: is there something we should do? And that's also the reason that we're now working on a tax transparency framework for crypto assets to ensure that the progress that we have made in traditional financial markets does not get watered down by alternative financial investments that we would not currently capture. So it's in a nutshell, it's always work in progress, and I think in principle we are trying to look to a standardized transparency architecture with regular exchanges, but I think it's also fair to say that to a certain extent, and whether that's on domestic level or internationally, there will always need to be a backstop where structures that we do not capture because there are smart people around that try to navigate around the rules that we have agreed, that we also have visibility on those. And I think that's where the MDR space, especially in relation to the CRS work we have done, then comes in.
Okay, thank you. Now, as a whole, while we've been talking, a number of other questions have popped up, as you may have seen. Starting with one from Ali aimed at James, really, which is, I think actually it says, when will the MDR go live in the UK? 2021 or 2022? James, do you want to expand on that a little bit?
Yeah. So thanks, John. Thanks, Ali, for the question. I think there is, as I said earlier, the government is looking to implement MDR as soon as it reasonably can, but there are obviously legislative requirements and practical points for both for businesses and for HMRC, in fact, on getting ready for that. So I can't foresee any circumstance in which it would be this year. I think it is 2022.
Probably 2022. Okay.
So live.
Currently, effectively, UK businesses have to report under what remains of DAC6, as it were, under this legislation. Ali's made a comment about the problem about uploading information, manual uploading challenges. Can you expand on that at all?
Yeah, I can say a little bit about that. So the reporting system for making DAC6 reports is now live. We have, I think, said previously, we foresee sort of two mechanisms for making reports. One is using the XML file upload, and the other is a sort of manual data entry for reporting. For the XML file upload, that is now available, and if you have an XML file to upload, you can access the portal. You need to register, and then you can go and do the upload. If you're wanting to report manually, we had to make some changes to that manual reporting tool following the amendments to the legislation. So that went live, or that is in the process of going live, but it's a little bit later. So it is now available, but if you want to use it, we're effectively running it as doing the sort of final tests alongside the go live. So if you want to use it, you can, but you will need to just contact HMRC, and you can do that on gov.uk. If you go to the reporting tool, there's the button to click to get in touch with HMRC, and then we will our colleagues from our IT teams will sort of help you walk through that journey and make sure that you are able to submit properly and make sure that everything's working correctly. So it is available, but at the moment, you still need to contact HMRC, and once we've, once we're satisfied that everything's working correctly, then it will sort of go live more widely without having to contact HMRC first.
Thank you, James. Another question has come up. There's a couple. I'm not going to take these exactly in order because I'll pick one that's aimed really, I think, more at Paul now, which comments from Keith PLC. It says, I don't know if I suspect that's just the way it's come out. With profit shifting still a growing problem, especially among OECD countries and national governments starting to look more inward due to the pandemic and so on, and perhaps due to Brexit as well, in the case of the UK, is it fair to say that BEPS has failed? This is the question I'm reading, and needs to be rethought, especially in the light of current events. And perhaps linked with that from the same person, suggests over 10 years ago, the UN was speaking about taxing the internet. Why will the OECD succeed where the UN where the UN didn't? Paul, perhaps you would like to comment on those.
Yes, those are, of course, big questions, and then I'll try to keep my answer short because I think there is a temptation to speak about these issues, of course, for a longer period of time. But I think, in a nutshell, I think the progress we have made under the BEPS Action Plan since it was launched back in 2013, so we're talking about a window of about 7 years, is really quite tremendous. I mean, I think we now have an inclusive framework with close to 140 member countries that have committed to the BEPS minimum standards. It includes all major economies, all G20 countries that are around the table. I mean, just a few numbers. Since we started the project, we have dismantled close to 300 preferential regimes. 36,000 rulings have been exchanged. There are over 650 tax treaties that have been amended. And so, one can always say, could we have done more? Could we have moved faster? I think the answer to that in a multilateral setting is always yes. I mean, if there would be one person, that's always the big question. If I would be the president of the world for one day, what would I change? And I think, everybody has his or her ideas about that. But I think the fact of the matter is we are in a complex multilateral setting with different economies in terms of size, in terms of level of development. And progress to be made on these complex matters, such as an international tax system or taxing the digital economy, that will always be gradual. But I think that if you look to where discussions were 10 years ago, for instance, discussions about a minimum tax rate, they were absolutely nowhere 10 years ago. And I think we're now really in a very advanced stage of trying to get our head around how a global infrastructure, not only on substance and on preferential regimes, but on tax rates more broadly may look. And I think that's tremendous progress. And the only way of trying to succeed is giving it a try. And it's a multi-year process. And I'm sure that we all agree that 2021 will be an extremely interesting year to see whether we can deliver real fundamental reform to the international tax system through a multilateral process. That's certainly what our ambition is.
If I can just pick up on that, Paul, I think the attempts to have multilateral agreements relating to tax and trade are always very difficult and clearly tend to take quite a lot of time. And I think the multilateral instrument that amends tax treaties that was agreed, I can't remember what year it was now, but a few years ago recently, I mean, was a tremendous achievement on the part of OECD. And perhaps it's not realised yet how much difference it's made, in that this one treaty has, in effect, by extension, as countries have signed up to it, has amended, it's treaties between sort of nearly 100 countries, I think it is. And if you work out the number of bilateral treaties that's involved there, it's something enormous kind of thing from one instrument. So although it took a long time to agree and so on, it's actually a very large effect. I don't think any of us can disagree with that.
So thank you very much, both of you. I was just going to say, I mean, that was a really interesting session earlier on. Was there something that stood out for you, Sabrine or Robert? Any surprises there, or any comments that you may have?
From my side, I think it will be a very difficult task for the three of us here to break down or to materialize the high political level of DAC6, Brexit of DAC6, etc., the developments of an international basis, to break it down. What is really of importance for the fund managers on ground, to put it this way. There's quite a gap we have to bridge. Hopefully we will be successful.
Mm-hmm.
If I can add a comment, I can say that we see the impact of the work of the OECD on the tax world, and it's really a huge work, and we really have to take care of all the rules given by the OECD, because it's really the change of our tax world.
Yeah, I mean, I think it's big structural changes are taking place. I think one of the key things that is worth bearing in mind from a UK perspective is that most of the industry was completely wrong-footed. We did not see DAC6 repeal or redaction or amputation, as it may be called, coming through. So much so that the Loan Market Association, clear documentation, written documentation, says that even if Brexit goes ahead and so on, transition period comes to an end, DAC6 in its entirety will continue to apply. And I think there is still a lot of, as Robert, you're referring to, at a policy level, a lot of discussion that is still taking place as to what this will mean from an equivalence basis and also from a good faith basis. Good faith is another word for basically no surprises for your fellow partners. So I think that remains to be seen. There is a memorandum of understanding that needs to be worked upon as far as financial services is concerned. And my real anguish and anxiety is really around that DAC6 doesn't become a political football, whereby financial institutions have been told that, look, hang on a second, you don't need to meet the full hallmarks, and we're just down to hallmark D, and next minute we basically sacrifice that and say, well, actually we will implement it because there is some horse trading that takes place at the end. So I think that wrong footing has happened once, and I think that creates a bad position for financial institutions. And I think financial institutions are asking very valid questions, particularly around the back book exercise. A lot of UK-based financial institutions have gone back for the last 2 years, undertaken long reviews under all the hallmarks, and were on the verge of actually submitting reports. And now we have essentially been told in the UK that we don't have to report under those. So the question arises, should we continue to hold that information? Should we expunge that information? And if we were to expunge that information, is there a risk that later on we could be asked to sort of like reinstate? So I think there are some real challenges for the financial services sector there. The other thing that I think from a UK perspective, if I may just mention, is up until now, the idea of multiple intermediaries was there. So whereby as long as one intermediary in the EU zone had complied under DAC6, that was sufficient. That particular aspect and the references to member states have now been expunged from the UK regulations, and that creates a situation whereby you could have an arrangement, say under hallmark D, that is reportable both at the European level and also in the UK. So these are practical things that obviously financial institutions are having to contend with. I would just mention one more thing, which is I think sort of like one of our attendees, Moinul, had highlighted, which is the challenges that have been caused by the repeal of HMRC guidance. Now, some of that guidance was actually really very helpful, and we had undertaken extensive rounds of consultation to hammer things out. And I think that's not just a loss for the UK industry, also at a European level. I think we had something useful to contribute in that debate, but that no longer is going to be, at some point, going to be, removed from HMRC website. So I think these are sort of like a couple of challenges that we have seen. Generally, the impact when it's purely UK-based financial institutions is generally minimal. All this has meant is basically there's less work to do, and that's great. The problem really arises the moment we go cross-border. And that is why we have this panel. And with that, I would ask if we can move to the first slide and specifically start looking at what does this, the redacted version of DAC6 in the UK, what does this mean for the industry? How do we start, applying it at a practical level to our structures? So that cross-border element is the challenge.
Our purpose for this session was to see and to explain where we will have DAC6 impact in presence of a UK intermediary or UK arrangement. Because even if the UK is now outside the EU and outside DAC6, we will have DAC6 impact in the UK as well. So in fact, we will have two levels of rules in the UK rules and also DAC6 impact. So this was really the purpose of the example we will try to discuss right now.
And I think that's a very valid point, Sabrine, because now any cross-border, any complex kind of financial institutions, previously they had generally, if they had, say, for example, businesses in Channel Islands, so they had only DAC6 and MDR to contend with. Now they've got DAC6, MDR, and whatever the UK version, whatever you like to call it, a hybrid or a redacted version of DAC6. So you've got three regimes. So that is definitely a challenge.
And you cannot only focus on hallmark D, because all the hallmarks will work.
Absolutely.
Yes, and as long as the slides are not, let's say, visible, the idea is we are talking about let's say the DAC6 disintermediation of the UK, and the fund industry, as everyone knows, is very much concentrated in London, and therefore a lot of the roles which intermediaries have to conduct would have been conducted out of London probably. And the other participants, being it the investors as the ultimate taxpayers or users, are still within the EU, and therefore a different risk pattern now applies. And this risk pattern for all participants should be analyzed and has to be analyzed quite quickly, due to the fact that for some jurisdictions, as Germany, the reporting deadlines had already been elapsed, and the other reporting deadlines for other jurisdictions will come quite soon, or will come quite soon. So, sorry.
No, that's fine. Thank you very much. I think we have the case studies now, and really, I mean, as Sabrine was mentioning, the idea is to bring this live. What does this mean? And the first case study we have is essentially a Cayman Island master feeder structure, which, as Robert said, quite often you would find a UK manager for that. You would probably have a UK prime broker as well, who would undertake securities lending and rehypothecation on their behalf. And the investments would generally be in listed equities and so on, both in the EU and outside the EU. So for that, do you want to have a first go, Robert, and sort of like looking at this kind of structure and seeing what does the redacted DAC6, how does that impact?
Yes, put it this way, all the slides, we have three level. The top level being the investor level. Usually they, as being the ultimate investors, they should not conduct, or they are not in a the position per se to conduct reporting by their own. Probably, most likely, they will not expect it. This might change due to the disintermediation of other intermediaries, especially the UK intermediaries. Then we have the layer, the fund structures, where the funds are domiciled and where are the manager domiciled, or very important, let's say, service providers such as prime brokers and so on, in which jurisdictions these service providers and the fund structures are domiciled. And last but not least, we have the, let's say, investment level as such. Either the investments are non-EU or the investments are EU-based. At least from a, there's a lot of discussion going on, but at least from a, let's say, our interpretation, we have it's only assets which are within the territorial scope of the EU are within scope of DAC6 reporting. In the case of hedge fund situation, as outlined here on this slide, being a Cayman Island hedge fund, the hedge fund structure as such is out of the EU. In the past, yes, very many of the fund managers are within the UK or are in the UK, and also the service provider are in the UK. And probably if there are any, let's say tax optimizations with EU equities or bonds, etc., either the portfolio manager and or the prime broker, lending desk, etc., might have to report. So the good news probably for the, at first glance, for the UK manager and for the let's say other service providers domiciled in the UK would be, at first glance, we are out of scope, no further reporting, at least from a risk management perspective, not quite a good solution. But what the case, so if it's purely a UK prime broker, purely a UK fund manager, no further reporting necessary. But what the case if the prime broker, the lending desk, is just a branch of, let's say, EU domiciled banking institution? For example, German, French bank, Severin will talk in a second, French-based bank with a French, let's say, branch, which conducts the services, or a German bank with a UK branch conducting these services. Severin, if you want.
Yeah. So this is really a very interesting example, because we will see the difference we can have in France and in Germany, because Robert will explain just after me what will happen in Germany if the head office of the prime broker is German, and I will try to reply if the head office is French, because from a French tax perspective, so the French tax authorities given some comments and issued their guidelines by the end of November last year. And we can say that according to the French tax guidelines, an intermediary that will be obliged to report under DAC6 can be a branch. That is to say that the UK branch, from a French perspective, can be considered, can qualify as an intermediary, because there is no need, in fact, to have a legal personality in order to be considered as an intermediary. But for being subject to a DAC6 reporting in France, a nexus with France is required. And in order to fulfill this nexus with France, the intermediary should be tax residents in France, or we should have a French PE through which, in fact, the services is rendered, or we should have an intermediary governed by French law, or an intermediary registered with a professional association in France. And we have a very interesting example given by the French tax authorities in their tax guidelines. about a foreign branch of a French intermediary, and they explain that the foreign branch will not be subject to tax reporting in France. So in our example here, we have a foreign branch, that is a UK branch, with now outside the EU, and this branch will qualify according to the tax authorities as an intermediary. And if, in fact, the services, that is to say the service provider, is only the prime broker located in the UK, that is to say if the branch, the UK branch, will act on a standalone basis, then we will not have a reporting in France. And the French head office of this UK branch will not be subject to an obligation to report under the DAC6 obligation. However, and this is really the main point, I think, we should take care of what will be the importance of the head office in that respect. That is to say, if a part of the French team has been involved in this arrangement with the prime broker, that is to say, if the prime broker will use the French back office team from the head office, then the head office located in France will qualify as an intermediary itself, and we will have a DAC reporting obligation in France.
Absolutely. So, Reen, that's a really good way of putting it. And I think we've got live issues as we speak, where we've got hedge funds who have gone through, completed the DAC6 analysis, and it was this kind of fact pattern where they assumed everything was in the UK. The nexus was created through the investment manager and the PB in the UK, and that was the end of it. Now with the if I can call it the DAC6 Brexit, what we have now got a situation where it's being driven by the structure and the activities of the prime broker, whereby that DAC6 analysis has to be basically refreshed in light of that. And the prime broker themselves are having to think about it, because if they're a branch of a German bank, we know that the UK rules were far more lenient, whereas in Germany, the reporting obligation was much higher. And in fact, we have got an opinion being thrashed out with council as to now, do we now follow the German rules? Can we still rely on it? So this is a really practical live issue. So thank you for bringing that out. If I may, in the interest of time, move to the next scenario. This is a private equity structure, whereas like before, we've got the fund investors at the top. We have the fund complex, if I can call it, mainly around the master feeder being in Luxembourg, which is a common thing. The AIFM, the Manco in Luxembourg, and the portfolio manager, the investment manager based in the UK, and investments, underlying investments in the target companies, both in the UK and non-UK. Sorry, EU, my apologies. Would you like to go first, Robert, on that structure?
Yes. What is, let's say, what we see here, as you outlined, Luxembourg, typically the onchorization, which took place, let's say, as a pre-Brexit planning for many fund houses, that they set up structures in Luxembourg with sufficient substance for regulatory purposes, etc., and so on. And they have the Menco and so on domiciled in Luxembourg, for example. And there was the question post or prior the change of the, let's say here, UK perspective, whether the Luxembourg, let's say, Menco is the intermediary which has to report, or whether the, let's say, the intermediary should be conducted or could be conducted by the general partner, by the fund manager, portfolio manager, as such. So we have here the first glance of multiple intermediary of a multi-intermediary scenario. And let's say all the knowledge is probably, or most of the knowledge is probably with the portfolio manager. The UK rule in the past were not too bad, to put it, not too stringent, to put it this way. So why not to report under UK law? Now the UK portfolio manager or general partner are not, let's say, within the game any longer. So all the obligations will materialize probably with the Luxembourg Menko, with the Luxembourg setup. This has to be kept in mind and have to be addressed, and a risk analysis have to be conducted. For the investors, at least from a German perspective, just due to the fact that, let's say, the role of the intermediary change should not create any, let's say, big headache at this point in time, to put it this way.
Sorry, any comments that you may wish to make on this structure?
Yeah, so in fact, in the French tax guidelines, we have some information about how to manage with the private equity funds. And the comments we can have from the French tax authorities are not very large, but we have some comments, and especially regarding hallmark A3. And in these comments, in fact, the tax authorities explain that the main purpose and the main objective of a UC is not to benefit from a tax advantage. And in order to fulfill this hallmark, so A3, we should meet the main tax benefit. And then, as the main tax benefit will not be fulfilled, we will not fall within the hallmark A3 with this kind of structure, according to the tax authorities. One point was also because, firstly, the tax authorities in their guidelines focus on the funds in order to explain the objective of the fund. But with the PE French Association, we also would like to have some comments from the tax authorities as regard the fund investors. That is to say, when you enter into a fund and when you are an investor, so is it an arrangement according to DAC6 reporting? And we have a kind of response from the tax authorities in that respect, and they explain the same thing. That is to say that normally the objective of the fund investor is not a tax objective, but a financial gain objective. Then we will not fulfill A3, the hallmark A3. And it's really also important to recall that the tax neutrality that will apply at the fund level is really compliant with the wish of the lawmaker in France and within the EU. And in fact, the purpose is really to put the investors in the same situation as a direct investment in the target's company. Then we will not meet this hallmark A3. So in this example, as explained by Robert, here we have a management company located within the EU. So the taxes reporting obligation will be on this on the ManCo because the portfolio manager located within the EU, the UK will not be subject to such a reporting now within the EU. And something maybe just to add, really important, and we discussed that during the first session. We will have after that an exchange of information between the EU tax authorities, and the UK will not benefit from this exchange of information. Yeah,
absolutely. And I think this, to me, this is a really interesting slide, because what it shows is actually there is there's no reduction in the DAC6 obligations for this fund structure. It remains intact. Only thing we have done is basically change the venue of where the intermediary is. So rather than UK, which was, as Robert said, a benign location, you're now having to subject it to a more complex analysis without the guidance. So that's a structure we looked at. Now, a bit more interesting one, which is a structure, what we're calling case study C. In this one, what we've got is similar kind of thing. We've got international investors coming in. Now, what's interesting here is that the fund structure is all non-EU. So you've got a Cayman master feeder, and you have a purely UK manager. So at the fund level, there is no nexus within the full DAC6 regime. And you've got obviously sort of like portfolio companies at the bottom, which have both a EU and a non-EU sort of like element to it. Who would like to go first?
Yes,
Robert?
yes. Thank you. If I may, here we have now really the situation for the fund as such and for the managers as such that they are probably out of scope of the let's say mandatory of any mandatory DAC6 reporting. So from a first glance, this may be good news for the managers and for the fund structures as such. But probably to not just to follow the first ideas, to have a second look on the risk features involved. And here now, let's say we have the level of the taxpayer, of the investors being the ultimate investors. Many of these fund structures are very often partnership structure, transparent fund structures. And then we have the investment level. And the investment level, let's say, typically target companies, we mentioned here, it could be also real estate. And in case of, let's say, typical private equity, the financing structures of the target companies or in real estate financing, etc., could trigger various hallmarks per se. And on the level of the investment in the various jurisdictions, there might be third-party intermediaries, lawyers, accountant firms, etc., who might trigger somehow reporting, the DAC6 reporting upon specific tax optimization structures. And then we have ultimately the taxpayers, and if there are no other intermediaries or reporting or conducting the reporting, the ultimate taxpayers or users, as we call them in Germany, might be in the position to conduct somehow reporting. So this is a very specific risk feature. Let's say investors have to be have to know or have to anticipate, especially, for example, in the German case where the deadline for the DAC6 reporting already has elapsed, end of August. Everyone was relying that the reporting will be conducted by the intermediaries, let's say by UK intermediaries. Now they do not have to report. What is my situation as an investor? But this is, let's say, the risk position of the investors, probably to address it slightly different also from the, let's say, managers. Very often, at least what we see and where we conduct also tax compliance, the general partner of, let's say, UK managers have agreed to file, let's say, the partnership tax returns for the German investors. So there might be a contractual obligation to conduct DAC6 filing some way. The filing of the tax returns now incorporate DAC6 reporting. So if the managers conduct the partnership reporting, they also will incur by filing the tax returns, let's say, competent DAC6 reporting too. And last but not least, if they do not do nothing, what is possible probably from a legal perspective, on the let's say investment side, on the asset side, the third-party intermediaries will conduct DAC6, probably conduct DAC6 reporting, and this will be somehow reflected on the investor level. So they are losing from a, let's say, business perspective, reputational perspective, they lose, let's say, the narrative, how what is reported upon their structures, yes or no, if they would not care about it. So we have different levels of risk and reputational issues to be probably to be addressed even after the, let's say, from a pure mandatory perspective, that the fund managers are very often out of scope. Sorry for talking too much.
So, Rain, do you have anything?
Yeah, I fully agree with all the comments of Robert. I just would like to add something in relation to the EU intermediaries, because in this case we have EU intermediaries, and normally the reporting obligation rely on the EU intermediaries, and these intermediaries in France can benefit from two exemptions. The first exemption is if there is another EU intermediary who will take care of the declaration and who will inform in due time the French intermediary, then the French intermediary will not have to report. But in this area and regarding this exemption, in fact, we should really, and the French intermediary should have appropriate evidence in order to demonstrate and to be able to demonstrate that the reporting has been made. And then we should have a very large communication between the EU intermediaries and in a very short period of time. The other exemption, and it's really interesting in France, the other exemption is if we have, for instance, a French lawyer acting as an intermediary, then normally we have an exemption due to the professional privilege and client privilege. That is to say that a French lawyer is not authorized to make the report unless its client give it agreement in order for the French lawyer to make the reporting obligation. But we should have an express agreement from the client in order to proceed to the reporting. And here we can see who will be the client of the French lawyer, because we can only have an agreement from our client in order to proceed to the reporting obligation. And we can see that it's not easy to know exactly who will be our client. And we also have another issue in the French tax guidelines, because if in fact, the client privilege is not waived by our client, by the client to the French lawyer. The French lawyer will have to notify, and will have to notify its client, but also the other intermediaries within the chain of the arrangement. And here, for us, it's a big issue, because if we are linked by the client privilege, we cannot notify another intermediary. And this is really a discussion we have with the French tax authorities in that respect.
Interesting. And I think this whole movement of responsibilities around reporting is an important one. And we've got a poll question, we'll go to it in a second, is really around, has this now complicated things? Because in this structure, the push has been onto the taxpayer. And the problem, as highlighted by Robert, is up until now, generally fund houses, whether they're private equity, real estate, or hedge funds, have always wanted to control the narrative, what was being said about them. And now you see a slight loss of that, unless you actively still undertake the DAC6 and you control that narrative by sending information out, or at least sort of like informing. So it becomes an investor relations exercise or a contractual exercise, which was never envisaged or wouldn't have been the case if UK had remained in. The other issue is just from a boundary perspective, we see obviously that at the portfolio company level, those responsibilities are clearly still outside of the fund setting. that is for those guys to undertake at that level. So with that, I'm just going to, before we go to our final slide, I'm just going to ask our participants to click on the polls and see if you can sort of like, the question is, has UK's redacted DAC6 simplified or complicated tax obligation for your investment structures? I'd just be interested to see what, you know, the experience has been of our attendees today. Interesting. It's neck and neck, as we see. So with a slight slight lead by more complicated, which, given that most of the participants on this call are likely to be asset management, sort of like financial institutions with a international footprint, that is expected. If you are a purely, as we said right at the outset, purely a UK only pure play, then that would probably make it much easier. Right, we've got a final case study. I'm just looking at the time as well. I'll just quickly sort of like pass that across. And Robert, do you want to just pick up on this? Well, actually, I'll just jump to the last slide. So this is case study D. And I think what it highlights and is more than what it highlights to me is that this is a complicated business, isn't it?
It's not, let's say, whether it's complicated, yes or no, it's another question, but it is all about, let's say, the flow of information and who controls the flow of information, who really, let's say, conducts the necessary reporting, who is the recipient. And in the, let's say, not in the pre-Brexit scenario, at least, we have a more, let's say, not seamless, but a more streamlined ultimate information and therefore reporting flow, due to the fact that the UK have been still within the in the EU, whereas now with the disintermediation, it is more or less the information flow and reporting flow have to be, let's say, re-engineered, and the re-engineering has to be addressed and take some time and so on. So that is really what is here triggering in fund-of-fund issues. You have to differentiate who is responsible, who is just the recipient, if other, let's say, the primary responsible reporting entity is out of the scope, what is with the secondary responsible entity, the users or the ultimate taxpayers. This have to be looked at in more detail.
Excellent. Thank you very much, Robert. I'm just going to sort of like see if there's any questions. I have a comment from John Buckridge, who basically mentioned that, you know, the reality of the situation is, I think it has complicated matters, and least of all, tax authorities who, you know, since Prime Minister Brown, we have had successive prime ministers in the UK. Tax transparency was the, you know, order of the day. I think, you know, there may be a policy change. John, welcome. And I thought, you know, good point for you to come in. Any comments that you may have on the redaction of DAC6 in the UK?
Yeah, just briefly, sorry. Yeah, I think it's more of, we're seeing it as a sort of, how do you deal with situations where you've got a London branch, for example, or you're in Germany, for example, or you're outsourcing services back into London, such as trading services. You know, you still got that. If you've got to say someone in the London branch of a, say, State Street, for example, or dual-hatted for the London branch of a German entity, head office, I should say, that you sort of DAC6 could apply on one hand, but it wouldn't necessarily on the other because of obviously the branch reporting. But in the UK, you wouldn't have that anymore. So I think it's just like complexities around how you manage the DAC6 risk still where you've got the branch activity in London, or where you could have an outsourced service provision back into London, where there could be a European headquartered office, for example. So they're the main things that we're sort of looking at, and also that you've still got Hallmark D1 and D2 sitting there.
Yeah, John, I mean, that's a good architectural sort of like point. The other thing at a transactional level, I mean, I know sort of like just for the benefit, your own expertise in the securities finance industry. I mean, we had of sorts reached a good position with AFME and ISLA, and the London community was feeling a lot more comfortable. I mean, do you think this redaction has thrown things up in the air as far as sort of like the prime brokerage activity is concerned?
I think it has. I was watching the fireside chat with interest, actually, when there was discussion around DOTAS. DOTAS is okay, but it doesn't look at things like withholding tax, fee income on trades. And part of DAC6 was I think, also targeting COMEX type transactions, whereas DOTAS doesn't really do that. So it was sort of a bit unique in its application as to how it sort of, for want of a better description, put a frighteners on the industry, because the hallmarks were quite searching. And I think there was initially a lot of discussion around fees for stock loan transactions, and whether they were seen as a tax, deriving from a tax benefit. And there's a long history of discussion around that. So I do think that with the redaction of those hallmarks, DOTAS is good, but it doesn't go as far as DAC6 with regard to cross-border arrangements that might have had a wider purpose around, such as withholding taxes, etc.
And you raise a very interesting point, John, which is in relation to how quite often tax departments were, for the first time, essentially leveraging DAC6 to institute proper governance structures in the financial services firms.
Yes, it was. I mean, we found it internally. It helped with the conduct aspect as well, and we sort of introduced, because DAC6 is also different to DOTAS as well. You've got the 30-day report. I'm sorry, that's not wrong to say that. But the 30-day obligation to report under DAC6, forget DOTAS, sorry, was something that we had to regularly remind the business about. Because obviously the high risk areas of a global markets business were particularly securities finance, less risk in other businesses, and some risk in onboarding. But when you're looking at securities finance, we had a lot of discussion around sort of monthly attestations, and they weren't sort of saying that I'm responsible for something. They were just saying, okay, I've got you. There's a 30-day reporting period. If I see anything, I'll tell you about it. And we were also reacting to the HMRC's view that you should have had in place a reasonable escalation process to get sort of non-tax trained people to get information to tax trained people where a decision could be made around reporting. So that in itself added to the good conduct, because, whether businesses were accepting those attestations and saying, yeah, I'll tell you as soon as I see something, they had a method to do it. Which was, I think, was pretty good, from that point of view.
The cleansing effect of DAC6.
You could call it that.
With that, may I invite Robert and Sabrine for any last comments before we close our session?
Robert?
I think I described too many, let's say, too much the downside of the risk. So let's or the other way around. I think a lot of information has been, let's say, consolidated, already prepared for reporting. So it is now just the time how to go forward with the already, let's say, the consolidated information and bring them forward in an appropriate way.
Thank you, Robert. Sabrine?
Yes, it's really a question of information and timing.
Absolutely. Well, thank you very much. It's been a really interesting panel. Really appreciate your insights. And I think, Robert, you're absolutely right. We did raise quite a lot of challenging questions and structures and so on. But the good thing is, with people like yourselves around, we do have answers, and there is solutions out there. So if you are interested and you want to discuss further, please give us a shout, and we'll like to continue the discussion. Thank you very much for your time.
Thank you very much.
Take care.
Thank you very much.
Thank you very much. Bye-bye.